Hello and welcome to the Chapter 3 video, where we are going to take a deep dive into cost volume profit analysis as well as planning. In this video, we are going to specifically look at the profit equation and how we can then use that profit equation to predict profit. We'll look at the contribution margin income statement, and then we'll look at the first part of break-even analysis, which is another term that we use for cost volume profit analysis. Now, overall, cost volume profit analysis is a tool that uses the relationships between our costs, how many units we sell, and the profit that we expect from selling those units. And it allows us to make predictions and estimates about the future using those relationships. So when we talk about profitability analysis, again, that's just an extension of cost volume profit analysis. We're looking at all of those relationships between our sales, our costs, and our profits. In order to understand our profitability analysis, we need to know our selling prices per unit. We need to know how many units we expect to sell, and we need to remember the information we've learned about cost behavior. In other words, we need to collect our data and group our costs together based on whether they are fixed, variable, and sometimes even mixed. So here is the formal definition of cost volume profit analysis. In my little intro, I wanted to make sure that you understood what cost volume profit analysis was at that time. Yes, we call it CVP, but in essence, again, and when we do this, we can do this in graph form, we can do this using formulas, we can do this using an income statement, but we're really focusing on the relationships between our costs, whether they are variable or fixed, our revenues, and our profits. And it helps us to make plans about our future. Now, why would we want to use it? Well, companies, the primary purpose of a business is to maximize shareholder wealth. And if we are looking to provide a certain amount of profit to our stockholders or our owners so that we can have enough to share dividends and enough to reinvest in ourselves, then it is important for us to predict how many units we need to sell in order to make a certain amount of profit. And that's what cost volume profit analysis does. If you're a nonprofit organization, no, you're not trying to maximize profit, but you are probably trying to work within a boundary in terms of a grant or a budget that you have been given. So cost volume profit analysis can help us predict how many people we can serve with a $200,000 budget. Now, here is the profit formula, which is really what we're supposed to be talking about in this first learning objective here. Now, I know this sounds really fancy, but you know what an income statement is. An income statement has our revenues and our expenses. Take the difference between the two, and we get our net income or our profit. Now, if we were to take that and turn it into an equation, we would say that profit or net income is equal to total sales minus total costs. We can further expand this formula because total sales is usually not just a number that's given to us. It's made up of the selling price per unit multiplied by the number of sales or unit sales that we have. So the number of units we expect to sell. And then with total costs, we know that total costs can be broken down in terms of a fixed component and a variable component. Remember, y equals mx plus b, where y is our total cost, m is our slope, X is our level of activity, and B is our constant or our fixed cost. Well, that still applies here. So we can expand the cost portion of our profit formula, and we'll have fixed costs plus our variable cost per unit. But that variable cost per unit needs to be multiplied by the same unit sales that we had up here for total sales. So there is the expanded profit formula, all nice and neat. Tons of words there, but I can certainly use this to predict profit at any particular sales level. So when we want to attack cost volume profit analysis or attack the profit formula, one of the first things we need to do is take a look at the company's costs and determine which costs are variable, which costs are fixed. Because in our formula, I'm going to need to find variable cost per unit because I need to multiply that times the predicted sales level. But for fixed costs, remember fixed costs in total remain the same regardless of the level of activity as long as I'm within that relevant range. So I need to separate my variable from my fixed. The other thing we have to consider would be our cost classifications because we have some costs that are related to making our product, and then there are some costs that are associated with running our business. For our cost classifications, we're going to look at our product costs in terms of materials costs and labor costs. For direct materials, these are the costs associated with getting the raw materials needed to make my finished product. So I'm going to take those raw materials and transform them into a finished product. So if I have a lemonade stand, we're talking about the lemons, the sugar, the water, the cost of all those things would be my direct materials. My finished goods, of course, would be the finished lemonade product. Now, for direct labor, these are the cost or the wages associated with the employees that actually touch my product, the employees that actually convert those raw materials into finished goods. So if I have a worker and they are pouring in the sugar and then they're doing the manual stirring or operating the machine that does the stirring or combines all of the ingredients together to make the lemonade, the wages that I pay to those individuals, those wages would be classified as direct labor. It's important to identify my materials cost and my labor cost because it also helps me separate my costs into categories. Typically, materials and labor, those are variable costs. The more units of lemonade that I make, the more costs I will have. So those are my variable costs. Continuing with cost classification, I also need to look at the final piece of my product cost or the costs associated with making my product, and that would be manufacturing overhead. Now, for manufacturing overhead, there is a variable portion and there is a fixed portion. So this cost is usually a mixed cost. So overall, when we talk about making a product, there are three basic costs associated with making a product: materials, labor, and overhead. Materials and labor, pretty straightforward. These are direct costs. They are variable costs. I know what to deal with them. For overhead, not only are these costs indirect, so it's a little bit difficult for me to trace them to a cost object, they also have a variable component and a fixed component. So an example of a fixed manufacturing overhead cost would be something like depreciation or the production supervisor's salary. For variable costs, we could have something like indirect materials or supplies on the factory supplies. Those items will be classified as variable costs. In addition to variable manufacturing overhead and fixed manufacturing overhead, now I have another cost component that I need to consider. So we're done with our product costs. Because when we look at a company, costs are either product costs or period costs. Product costs associated with making my product, materials, labor, overhead. We're good with that. Period costs are those costs of running my business. And we call them period costs because we usually expense them when they happen. Things like advertising, the salaries and wages that we pay to our accounting staff or our HR people. We call these selling and administrative costs. Sometimes we call them selling general and administrative costs. Well, these costs, just like overhead, have a fixed portion and a variable portion. Again, we need to separate those out in order for us to apply cost volume profit analysis or to even use our profit equation. So here's a great example using the profit equation. So we have this company that produces and sells only one product, ice cream bars, for $1.50 each. To ensure top quality, no inventories are maintained, which is important when we do cost volume profit analysis. We'll talk about this in a bit, but one of the assumptions are that there are no changes in inventory. So in this case, no inventories are maintained. So my numbers are good. Now we have our estimated cost, and our cost include either our product cost or our period costs. We need to separate these in terms of variable and fixed. So for our variable costs, we have our variable product cost, also known as manufacturing costs. We like to use multiple terms for the same thing. So we have materials, labor, and overhead. And then we have our variable selling and administrative costs. All of these costs ultimately appear on our income statement. And then for fixed costs, we have our fixed manufacturing overhead and we have our fixed selling and administrative. So here is the profit formula. The beautiful thing about this is everything on the variable side is expressed in terms of cost per unit. Remember that for the profit formula, we're going to set profit equal to our sales minus our fixed costs minus our variable costs. We want to determine what amount of ice cream bars would we need to sell in order to earn $1,000. So we're going to set our equation equal to $1,000. That's our profit. And then we are going to take the sales price of $1.50 each and multiply it times X. X represents my volume or the number of ice cream bars I need to sell. I don't know that. That's what I'm trying to find. So we're going to call that X. Then we're going to subtract out our fixed costs. We have manufacturing overhead, selling and administrative. We add those together, and that is my fixed costs. Then we are going to subtract our variable costs per unit, again, multiplied by X, because our variable costs in total, they're determined by our level of activity. So we're going to take all of our variable costs per unit, add them together, and then multiply it by X, the same amount that we would multiply the sales price per unit by. At this point, we're going to solve for X. So we'll combine our like terms. We'll isolate the X on one side, and when we finish solving for X, we get this 6,950 ice cream bars. Now, I could, of course, plug in the 6,950 ice cream bars and determine that when I multiply that by that sales price, subtract out the fixed costs, and then subtract out total variable costs, meaning take the 110, multiply it by the 6,950, and then subtract, I'm going to find a profit of $1,000. If you still don't believe it, you can take the time to create an entire income statement with all of these numbers to prove that at this sales level, profit will be $1,000. Now, that's a great lead in to the income statement that I was talking about. All of the income statements that you have probably seen at this point, if you're talking about financial accounting, has been a gross margin income statement where we have our cost of goods sold at the top and then we have all of our other operating expenses at the bottom. The focus is on calculating gross profit and net income or profit. The contribution margin income statement separates our costs in terms of variable versus fixed. So we're not concerned about having product costs at the top and operating costs at the bottom. We're concerned about having variable costs at the top and fixed costs at the bottom. Now, this is what I was telling you about with the gross margin income statement. We also call this a functional income statement. And we call it a functional income statement because it separates our costs by function, meaning product versus period, or our manufacturing or product costs at the top, and then our other operating costs at the bottom. So we take our sales, we subtract out our cost of goods sold, which is made up of our three basic product costs, materials, labor, and overhead. We don't care that it's variable and fixed all in there together. That's fine because we are concerned about gross margin. Gross margin represents the amount of money we have left over after we cover the cost of our products to run our business and to make a profit. So then for gross margin, we then subtract out our selling and administrative costs and we arrive at our profit. All right, it would have been better if I clicked through as it was highlighting, but I forgot that it highlighted this information. Now let's look at the contribution margin income statement or the contribution income statement. Now, unlike the functional income statement or the gross margin income statement that we just saw, on this one, we separate our costs in terms of variable versus fixed. So instead of gross margin or gross profit, we calculate contribution margin. Contribution margin represents how much I have left over after I've covered all of my variable costs to cover my fixed costs. My fixed costs are static. Even if I had no profit at all, I would still have these fixed costs. So it's important for me to separate these out so that I can know at a minimum what is it that I need to sell to at least cover my fixed costs because they're going to be here even if I don't have any variable costs. So here we take our sales amount calculated the same way, the units multiplied by $1.50. This is again just a proof of the little formula we used before to demonstrate that we can get a profit of $1,000 if we sell 6,950 ice cream bars. Now we have all of our variable costs. The variable costs include both manufacturing and our period costs or our selling and administrative costs. Just make sure it's only the variable ones. And then we'll add all those together, subtract that from sales, and we'll arrive at the contribution margin. And then we subtract out our fixed costs, and that gives us our profit. So in this example here, the contribution income for the month for Chillin' Times, and this is our ice cream company, is as follows. We have our sales, our variable costs, contribution margin, fixed costs, and profit. This is the same as what you saw on the previous slide, only everything is condensed. We don't see all the detail for variable costs and all the detail for fixed costs. Now, one of the things that we can help us in break-even analysis or cross-volume profit analysis is using our contribution margin in terms of units to help us calculate a break-even point. And when I say break-even, that's how many units we need to sell to at least cover our costs. No profit at all, but covering our costs. Now, with contribution margin per unit, contribution margin is found by taking sales minus variable costs. We can express this in terms of per unit, percentage, total dollar. You just need to make sure that you're comparing apples with apples and oranges with oranges. So with contribution margin per unit, just take the sales price per unit, subtract out your variable cost per unit, and then you have your contribution margin per unit. We can also express this as a percentage, and we call this the contribution margin ratio. For the contribution margin ratio, we're going to take contribution margin in dollars and we're going to divide it by sales. Now, if you see the detail here, notice that it's showing me sales minus variable costs, and then we're dividing by sales. Well, this is how you find contribution margin, sales minus variable costs. So we're going to take the difference between those two, and that is what gets divided by sales to find the contribution margin ratio. Now we can use the contribution margin ratio to help us measure the sensitivity or how sensitive our profits are to a change in sales. So if sales happen to increase by 100 ice cream bars, how much will net income increase by? Now we know if we sell 100 additional ice cream bars, I can't just take the sales price and say, oh, that's going to be my increase in profit. No, I'm going to have some additional variable costs. That's why the contribution margin per unit helps me determine what my profits will increase by if we had an increase in sales. So if I take the increase and multiply it by the contribution margin per unit, then we get the $40. That is how much my net income will increase by if I sell an additional 100 ice cream bars. Now I know that 100 times $1.50 is not $40, but my profits are not going to increase again by the sales level. It's going to increase by the contribution margin level. So that's why we can take that and multiply it by contribution margin per unit. Now, if I wanted to know this in terms of dollars, in other words, if my sales increase by a certain dollar amount, how much profits would increase, then I would need to use the contribution margin ratio, where we would take that increase of 1050 and multiply it by the contribution margin ratio, and then we're going to see an increase of $280. So it's a shortcut way to answer this question without having to go through all of the work of recreating a contribution margin income statement or plugging everything into the profit equation. So in sensitivity analysis, we can use our shortcut of contribution margin per unit and contribution margin ratio. All right, let's take some time and look at a couple of cost volume profit analysis items with the break even point. We're working our way to this because we've just done the sensitivity analysis. You know what contribution margin per unit is, you know what contribution margin ratio is, and those are important components of break even analysis or the break even point. And this is also going to help us in profit planning. Now, I've mentioned break even point a couple of times, but it bears repeating. The definition bears repeating. It's when total revenues equal total costs. There are no profits at all. We call that our break even point. That's the minimum. If my sales level happens to fall below my minimum, then I have a net loss. We usually want to at least cover our costs. So this is an important analysis that needs to be done. Now, there are a couple of ways that we can compute the break-even point. We can take time to prepare a contribution margin income statement. We can use trial and error to work our way back, or we can use the profit equation where we will set our profit equal to 0 and then work backwards so that we can find the sales level at which our profits would equal 0. Or we could use this formula. And with this formula, we're going to take fixed costs and we're going to divide it by the contribution margin per unit. Now, typically, let me go back so that you can see that, but typically companies want to operate at above a break even. Now, in this orange, I guess this is orange, yellow, whatever color it is in this formula up here, it's just another way of demonstrating how total revenues equal total cost. So if we set our total revenues equal to our total cost, that is another way of finding our break-even point. So let's do this with an example. Again, the easiest way to do it is just with the formula. So let's see, we have the same ice cream company selling the ice cream bars with a $1.10 unit variable cost, and that sales price is $1.50. So they're selling it for $1.50 each. Fixed costs are $1,780. How many bars must it sell to break even? Using our formula, we're going to take our fixed costs and we're going to divide it by the unit contribution margin. Unit contribution margin is not explicitly given to us, but we can find it because contribution margin is sales minus variable costs. Just make sure you're comparing apples with apples and oranges with oranges. So we're going to use our sales price per unit, subtract out our variable cost per unit, and that's going to be our denominator. I'm going to take the 1780 and we're going to divide it by that denominator, and we can determine that at 4,450 units, we don't make a profit. We just make enough to cover all of our costs. So as long as the company sells this level, they can at least break even, and they'll use that in their planning. So they won't set a budget for a sales level below this because they won't make any profits. This will become their minimum amount. Now, we can also use that break-even formula that we just saw, modify it a little bit, and we can determine how many units we need to sell in order to make a certain amount of profit. In other words, the same thing we did, but we used the profit equation before. Instead of using the equation, We can save some time and use the formula. Now, what if the company wants to earn a monthly profit of $800? How many ice cream bars must it sell? So now we're going, instead of just taking fixed costs and dividing it by unit contribution margin, we're going to change our numerator. We're going to take fixed cost, add in that desired profit, and then we're going to divide all of that by the unit contribution margin. So we have our fixed cost of 1780. We add in our desired profit, and notice that we need to divide it by the unit contribution margin, but we get the 6,450 units. Now, of course, this answer was different from the one we did before because before we were looking at a profit of $1,000. This is at the $800 level. Now, we can take all of this information and we can create a cost volume profit graph. When you initially look at this, it may look like a bunch of chaos that makes no sense at all, but I promise you, it'll make sense. And if you've gone through cost accounting or you remember the managerial portion of accounting too, then this graph probably looks familiar to you anyway. Now, in looking at this graph, the x-axis is the level of activity or the number of sales, unit sales. The y-axis is our dollar amount. And I won't say cost because we're going to have a revenue line here. So it's actually revenues and costs. Now, let's go through line by line. Let's start with the red line first. How about we start with the red line? The red line is my total cost line. This line is actually a mixed cost, meaning if I have no level of activity, then I still have a certain amount of cost. Why? Well, total cost includes both fixed and variable. My fixed amount, or for my fixed cost, I'm still going to have fixed costs whether I sell anything or not. So for fixed costs, it's going to start at a certain level. That's why for total cost, it doesn't start at zero because even if I don't sell anything, I still have some cost. So that red line there is my total cost line. Here's my equation. Oops, went ahead. Here's my equation for my total cost line. It is my fixed cost plus my variable cost per unit. So that's 110, it should be times X. Now, let's look at the different components here and continue with the revenue line. With the revenue line, if I don't sell anything, I don't have any revenue at all. So that one does start at 0, 0. And we can see it progressing upwards. The equation for this one is $1.50 times X, X being the level of sales. Now, for my variable cost line, same thing as the revenue line, in that it's starting at 0, 0. If I have no sales, then I have no variable costs. But it's $1.10. So my equation for this one is $1.10 times X. The difference between my variable cost line and my total cost line, of course, is just fixed costs. Now, if you take a look at the total cost line and the revenue line, at some point they intersect. That point of intersection is the break-even point. And we calculated the break-even point to be 4,450 units. At this point, there is no profit, no loss because my revenue line is equal to my cost line, total cost line. Now, take a look as my revenue line continues to increase or as it ascends. And my cost line ascends as well, but not as fast as my revenue line. So when my revenue line is above my cost line, I have a profit area, which is above the break-even point. If my sales or units in sales, I should say, happens to fall below the break-even point, then my cost line exceeds my revenue line and we have a loss. Now, on this graph here, instead of having all of my costs and all of my revenues, we could condense it and turn this into a profit volume graph. So with the profit volume graph, as profit falls below zero, then of course that is my loss area. My break even point is on that x axis. So instead of the x axis being unit sales, it is actually my profit. Nope, said that backwards. Instead of my x axis being unit sales, it's actually total revenues. And my y axis is my profit. So as it crosses here, we can see that profit is zero when my sales volume is 6,675 in dollars. Press the wrong button. There we go. Now, when we look at just about anything in managerial accounting, there are certain assumptions. Accountants like to work in fixed areas because sometimes when you get outside of those fixed areas, then a fixed cost isn't really fixed, a variable cost isn't really variable, and we're not looking at the flat part of a curve. We are actually looking at an economist curve where we're all over the place, and we can't deal with that as accountants because we need to make predictions and estimates. So whenever we do cost volume profit analysis, we make certain assumptions. First of all, we assume that all of the costs are fixed, truly fixed, and all of the costs are variable, truly variable. So we can classify all of our costs as either fixed or variable. We are also assuming that there is a cost function that has a true relationship between the level of activity and the actual cost. In other words, we're operating within that relevant range. And when I say a variable cost is truly variable, there's also a direct relationship with the level of activity. In other words, as we sell more units, it makes that cost go up. We are also assuming that the revenue function is linear, that there's that true relationship between the level of units and total revenue. So it really does look like a line. Any analysis that we're doing, we're assuming that we only sell one product, or if we sell multiple products, then there is actually a sales mix or a ratio that remains constant. So if I'm selling ice cream bars, ice cream cones, and cups of ice cream, then for every one bar I sell two ice cream cones and three cups. That 1 to 2 to 3 ratio remains the same in my analysis. Now, could it change? Yes, absolutely. But my prediction is not going to be any good. And I need to find my new ratio in order to make predictions about break even point. All right, that takes care of the first half of chapter 1. Join me in the walkthrough video where we'll do a couple of problems and then we'll continue in another video and talk about some of the other objectives in this chapter, including a multi-product situation as well as after-tax situations. I appreciate your time and attention. I hope you have a wonderful day.